Hey, welcome to another episode of Spilling the Beans. Today I'm sitting down with Ron Phillips. He's actually one of the OGs. He was on Spilling the Beans, one of the first episodes back a little over 2 years ago now. And a lot of things have happened over the past 2 years. Ron has a big turnkey real estate business that flips over 500 houses a year. And he invests in commercial real estate as well. And just a wealth of knowledge, been around the block for a long time, or many times, and for a long time. And just a great, great dude. So I'm excited to sit down with him, share some insights of what he's seen over the past 2 years and what he sees moving forward and how to bulletproof your business. So let's go meet up with Ron. So Ron Phillips, appreciate you being here, man.
Oh, always a pleasure.
Always respect our conversations and enjoy them. So, dude, you're one of the OGs from Spilling the Beans originally when we launched this.
I know, it was fun.
Over 2 years ago, right?
Yeah, in downtown Charleston.
We were downtown, we're hanging out down there, and now we're in Mount Pleasant, nice little setting, and we mix it up. We go to all the different cafes and stuff, but dude, lots happened in the past 2 years. And so I thought it'd be cool. I respect the heck out of what you've done in business and how you've built a business around your lifestyle and know your priorities, you know?
Right.
And so I'd love to hear about, you know, kind of what you've seen in business over the past 2 years, what you've experienced. There's been it's been a crazy market, man, since the past 2 years of what's happened.
Nuts.
And we're talking offline about what the next 2 years are going to look like, or, you know, nobody knows, but we can speculate on some things. I want to talk about all of it.
Cool.
So
well,
let's give me an update. What's happened for you over the past 2 years?
So my main business is selling investment properties, mostly 1 to 4 family units to investors, to
Turnkey,
our investors.
right?
Yeah, right. So that over the last 2 years has been absolutely nuts. So it was crazy. In 2022, we had one of our best years, and we fought the entire year to get inventory because the deals were great, the money was cheap, everything was right, but it was right for the retail market too. So, you know, a lot of our suppliers were like, yeah, I don't really need you guys now, because you could put a property on the market and it would sell in, you know, 30 minutes and, you know, for record profits.
Yep.
So last year we probably could have done 2 to 3 times the amount of properties that we did.
Because of demand?
You know, 1,000, 1,500 properties last year. If we had the properties, we literally couldn't get them. So that was really frustrating. And in spite of that, we did unbelievably well.
Yeah.
And then everything towards the end of the year started to, like, really just, you know, contract
Because of rates going up.
Yeah. So everything kind of like. We saw this shift, and it happened so fast. It was funny because in the mastermind groups, everybody was saying, hey, get ready, get ready, get ready, get ready. You know, because, well, I mean, nobody really knows what's going to happen, but you get this feeling like something's not right.
Yeah.
And something's going to happen. And then they started raising the interest rates because of inflation, and all of a sudden, the market just stopped. I mean, it just stopped. In a lot of different markets.
It scared the heck out of everybody, man.
Yeah.
Like, what's going on? And it was almost like, there were almost like, I don't want to say it's parallels to when COVID happened, but like everybody was like, all right, just pause.
Yep.
Don't do anything. Let's figure out how things shake out. And there was a little bit of that for a couple of months late last year.
And we got calls from people. It was we became the sexy chick at the dance again, all of a sudden. Like, first part of the year, we were the ugly, wall child that wouldn't even go down. You couldn't get them on the dance floor.
Yeah.
And then, end of the year, we're the most popular girl at school. It was amazing. A lot of people came back and were like, "Hey, we've got standing inventory." So that helped out the end of the year.
Yeah, from a supply standpoint, everybody said, "Hey, I'm sitting on inventory," but your buyers were steady regardless.
Yeah, still are, still buying.
And they're mostly cash buyers, right? Or
No,
they finance
mostly finance, which is interesting because with the interest rates that they having gone up, you would think that they would go away, and some of them have. But we're constantly getting new investors, and you compare the returns that you can get in real estate today. Cash on cash, leveraged, you're probably 8%, sometimes up to 10 on turnkey stuff. Well, compare that to what else you can get out there.
Yeah.
I mean, you're 4.5% in a money market, nothing in the bank. And most people don't have the sophistication to be able to go out and find really, really good deals because they're working
they're busy
full time. So our client are people who don't have time to go do what you and I do, and those people need help just like everybody else. Well, you take the cash on cash return along with appreciation gains, depreciation, and principal reduction. There's not a sexier return, even with returns as low as they are right now. There's not anything that's better. So they're still buying.
There's nothing safer. There's nothing more predictable. There's nothing that has better tax advantages.
That's
that has
pegged
the
to
equity
inflation.
growth, traces inflation, and the principal pay down and all the other appreciation factors.
I mean, principal reduction itself first year is as good as you're going to get in a money market.
Yeah. Yeah. Well, I mean, with treasury bills and money markets are paying, like my bank's like, hey, you bring new money, it's a liquid account, there's not even any tie up on your funds. You can transact them 6-10 times a month. You can't use it as a checking account, but you can move money in and out. Fully liquid, they're paying 4.5% to 5% right now.
Yep.
So how has that slowed you down and with zero risk?
Not at all.
Not at all, huh?
Not at all.
Because the people who understand, there's very little risk or very mitigated risk in the single family.
You're still on the wrong side of arbitrage when you're getting. I mean, I have money sitting in a money market as well, and it's getting 4.5, and I'm on the wrong side of arbitrage. I keep that there for liquidity purposes, but that money is losing money to inflation every single day. As good as 4.5 is, it is not good enough for inflation. You're still losing, depending on who you believe, the government or other statistics. You're still losing 2 to 6 points on your money, which is not good. So you've got to have liquidity, but then you should also have your money invested, in my opinion, as much as you can.
Are your investors expecting a higher return now because interest rates have been pushed up and everything else?
Nope.
So if they can get a tax advantage return, cash on cash at 10%, they're all over.
Yeah, absolutely.
I was talking with my buddy Mike Wilkinson, and I was like, dude, if I can make 10 to 12% consistently on my money with little to no risk on my principal, I would do that all day. I'm not looking for grand slams. I'm not looking for home runs.
Who wouldn't do that?
I just want consistent returns over time.
Look,
the smartest financial people just want consistency.
The only real challenge to a compound curve is interruption in the curve. So that's the big fallacy in the stock market when they tell you just leave your money in the stock market and you'll be fine because it gets whatever 8 to 10% a year. Well, that's crap, because if it did that consistently, that'd be one thing.
Right.
But it does not do that consistently, as everybody knows, and because it doesn't, it interrupts the compound interest curve, and then you're starting all over again. The problem is, if people actually look at a compound interest curve, it's really, really low and boring for a long, long time, and then it spikes.
Yep.
Well, every year you miss, you don't miss off the front end. Everybody thinks you miss off the front end. You don't. You miss off the back end. And if you start chopping years off the back end of that curve, it just slices your compound curve down. And it increases the amount of time that you have to stay invested in whatever it is you're invested in.
Well, I think you make a great point, because people look at, you sit down with any financial advisor, hey, this mutual fund or our stock has gone up by 8% every year. Average annual return is 8%.
That's the key, right? Average annual.
You would have a lot more money, and then they give you examples as if it did go up 8% every year consistently, but that's not what happens.
Never what
happens. It goes
happens.
up, like think about this, you got $1 million in a bank account, or in a mutual fund account. If it goes up by 20% one year and then down by 20% the next year, you're like, I'm back at break even. No, you're not. The average of the returns is 0, but what does it actually do to your money? You went up to 1.2, and then you came down to 960. So the dollar amount that's in your account is actually less. Every time it goes up
less
and
than
down
your
like
capital
that.
is is what happened.
That's what I'm,
Yeah.
less than your initial capital
Yep.
investment. So every time it goes up and down, which the stock market consistently does,
Yep.
it actually hurts your overall dollar amounts in your account versus, which is why they don't show you what happens to your dollars over time. They show you what happens at the average of the returns over time.
Correct. And they don't show you, hey, here's an actual client that kept their money in the stock market, just as I said, for all this time, and here's where their account is.
Yeah.
What they do is they project from today out using average annual returns, which is fraud.
Yeah, it is. It should
Now,
be, man.
then they compound the fraud by comparing the 8 to 10% to real estate's 3 to 5%, as if they're equal.
Yeah.
And there's multitude of reasons why they're not equal. The first is almost nobody pays cash. They're leveraged. And the only way you can do leverage over here is really risky and really dangerous, where this is actually safe.
Right.
Okay? That's the first fallacy. The second fallacy is that they're acting as if that's the only return there is. Well, that is the only return in the stock market, generally. Sometimes you can get a dividend-producing stock that also does growth. That's 2 compared to 4 over here, which we already talked about, right? You can't compare them.
Yeah.
You can compare the appreciation, but as soon as I lever that, I destroy your 8 to 10
Yep.
anyway, levered.
Yep.
And I have 3 more returns where if something happens to the value of my house or my property, it's irrelevant because I'm already getting cash flow return, I'm getting principal reduction, and it's very tax advantaged. I get 3 other returns that are producing while my property lost value.
Yep.
And my property doesn't care. Its feelings don't get hurt.
Dude, I would, and here's the thing. You're a student of personal finance and of wealth building. Same with me. I've dedicated my life. I've always been fascinated by money, not necessarily for what the money does, or not for the money itself, but for what the money does, like what you can do with that money, the impact that you can make with it. But I've always been a student of personal finance and understanding wealth and how do you build wealth and preserve wealth and maintain it long term. And dude, if there was something better out there, I'd be doing it. I promise you that. You know?
I keep waiting for someone to offer me something better.
There's nothing that's, can you make
Business. Business is the only thing that is potentially better because of the multiple that you can get on a business. And the cool thing about it is, at least with commercial real estate, it is exactly the same. The multiples are different, but the general idea is the same. It's based on financials, and the same thing with business. And you need a team to run this. You need a team to run this. It's basically, if you do investing in real estate the correct way, it is a business.
Yep.
Therefore,
And
that's why
that's
those
the key.
two are the same, right? It's just a different widget that we're selling.
You can take the real estate, you buy a building for $1 million, you can make it 1.5 million. You can buy a business for $1 million and make it $5 to $10 million. At the same time, this isn't going to go to zero. A business poorly run can go to zero.
Absolutely.
And so, and the real estate has more tax advantages than even a business does.
100%.
So you balance that out. But I agree 100%. Like I have three businesses, I would call it just business that are not real estate based, and then obviously the real estate. And I like these because they generate faster money, for the most part. Like I can say, hey, we need to launch a new product or host a mastermind or do some sort of a consulting offer or whatever, and we can make fast money over here. And then this is the
and then
slower
deploy it over
wealth,
here. Yep.
Predictable long term. No, I love that. So what do you guys, all right, interest rates have increased. Supply is still down. Demand is still up.
Which is funny because supply for us is up. It's down for the majority of people, but it's up for us because the owner-occupied sales are down, which has scared builders and it's scared rehabbers to coming back to us. So ours is actually up, which is fantastic. And we're getting really, really good deals, not in the form of price reductions, but in the form of incentives, which actually work out better because the incentives improve the cash flow.
Like terms, like seller financing terms, or some sort of
all kinds, you name it. We're getting about as creative as you can get. You have to get really creative now because the interest rates are north of 7%. And so
I think the creative finance, whoever understands that game, I think that is the number one skill that will help you own the market over the next 24 months.
Yeah,
like,
I agree.
I think that's the game changer from what I'm seeing and what we're working on too. And everything that we do is all creative deal structure on both the buy side and on the sell side. And I realize, hey, if I want to get my price point, I need to offer terms.
Yep.
And seller finance it at very attractive terms, right? If I want this higher price point and they're going to assume debt at this and I'm going to seller finance at this and they have to go and raise money at this, my seller finance might have to be at 2, 3, 4%, right? But at least I know that I have a note and I'll get paid on that in the next 3 to 5 years.
And it's more tax advantaged anyway. So
Exactly. I love it, man. So what are you guys seeing in the market as far as, are your investors opportunistic right now? Are they like, hey, I'm going to hold on to my cash and wait for
we have both.
deals that pop up?
We have both. We have people who are waiting, and we have people who are just investing. And what I tell people is, look, kind of like what you were saying with the 10 to 12%. If the deal works for what you're trying to accomplish, why would you wait?
Right.
Your money is losing money in
Right.
the bank. So, you've got this money over here you've set aside for investing. If you set it aside for investing and then you leave it over here sitting, you're losing money. And if the deal works, then the deal works. If it works today, it works today. If it worked last year, it worked last. It's always going to work, unless you're sitting around trying to hit a home run. And if you're sitting around trying to hit a home run, you're probably just going to strike out.
You're more likely to. This is a philosophy. As you're talking, I was like, the philosophy that I always try to impart on both the active operators and my passive investors is that ball games are won with base hits.
Yep. You
Consistently over time, just get on base, get good deals, safety, like predictable deals. Don't try to hit most of the home runs. Turn into strikeouts, man. They look so good on paper, and then there's hair on it somewhere. It was hidden. It was like.
And occasionally, when you step up to bat, and the ball is thrown perfectly, and you swing at it like you would normally swing. I don't even play baseball, but this is going to work.
It's
I think.
a good analogy.
Some baseball person's going to comment there and be like, "That is not how it works." Anyway, when the balls come in the right speed and you hit it just right, you hit a home run anyway.
Right.
You don't have to be swinging for the home run to hit a home run. It just happens. And you score if you knock the next guy in one base. If it's just one, you still score.
Yep.
It doesn't have to be a home run. Sometimes you hit an inside the park grand slam home run.
Yeah.
It does happen, but it's super rare. And if you wait around for it, your money's just gonna.
Well, that goes to your deal, the office building deal that we were talking about offline. You find an office building. There's a big business tenant that's in there, single tenant, right? And you bought it for 3.6. You said
3.8.
3.8. And you acquired it, but they had moved out, and they still had 6 more years left on the lease.
Mm-hmm.
And so they're paying you rent,
Which is concerning.
Yeah. Okay.
That's concerning.
So what did the phone call look like when you talked to them?
So what happened was that the company that was there was acquired by a very large company, which is what normally happens in business, right? Well, when they acquired them, they were like, well, we don't need any of this over here anymore. So they
consolidate,
just moved
be
out.
more efficient.
So they just moved out, and they just kept paying the rent. Now, what I can't figure out for the life of me, and when I was trying to figure out this deal, and I was trying to figure out what the heck was wrong with it, I was trying to figure out why the heck the owner didn't try to do a buyout with them and then sell the building, because he would have doubled down.
Mm-hmm.
Like, I don't understand what happened, but he didn't for whatever reason. And so the day after we closed, we called, my partner and I called, and we got the CFO and we said, hey, we're the new owners. Here's our wiring instructions. He goes, cool. We'll send over the payment today to you guys, and we want a buyout. And we thought we'd be in for like maybe a year or something, and then we'd get a buyout or something like that.
Let them feel the pain for a little bit longer.
So we negotiated for about 30 days, and we started really high, and they started really low, and then we met in the middle at $3,050,000. So
you bought the building for 3.8. You bought the building for 3.8. You settle at $3,050,000 a month after you bought the building.
Correct.
So you're into this now for $750,000.
Correct.
So what's the next play? What do you do?
So we our choices were we could sell it. We could put it back on the market and sell it, and we could
What's
we
the
could
as-is value? 3?
probably get 3 out of it. But my partner and I don't want to do that. I mean, we basically own it free for all intents and purposes. And it should generate somewhere around $400,000 a year. So why sell it? So we cleaned it up, redid the parking lot.
You're talking about a 50% return, right? 50% cap.
Unbelievable.
Yeah.
We're just gonna. It's on the market right now. We just got it cleaned up. We took pictures last week. It's just hitting the market, and it's 20 minutes away from the new Ford plant that's going in for like $6 billion or something that they're putting in. So we're thinking probably some manufacturer is going to come in there and set up shop. That's the other thing is it's an office building, but it's zoned industrial. So
is there a warehouse in the back?
Doesn't have to be. Kind of. We'll have to do some TIs to it, some tenant improvements to it to make it work. Yep. And there's a lot on the side that we own where we can put in bays, so we can make it a warehouse, small little manufacturing something. Really cool little building, and it sat there. Nobody looked at it because it was office.
Yeah.
It's the office nobody's looking at.
It's got a bad vibe right now, man. Office getting crushed. But I think these unique properties still have. I mean, everybody looks at it from a macro level, and this big building in San Francisco just went back to the bank, went on auction, and sold for 20 cents on the dollar, and the office is down by X% in New York and Chicago. It's like where the economy's growing, where there's still things going on, Charleston, South Carolina, and different areas of the country, there's these unique properties that are still in demand, right? Like they're still supportive of these larger economic anchors.
There's a lot of business that still needs office.
Yeah.
And whether it's a traditional office or it's flex space or it's like a warehouse kind of a deal, and so because it's got that dual zoning, there's a whole host of things we can do with it. And I mean, we could rent it for $100,000. We could rent it for $200,000. It doesn't make any difference.
You rent it for $100,000. You still have a 13% cap rate on it. You know what I mean?
So
you can be so creative with it.
Inside the park, grand slam home run, and that doesn't happen all the time. That we didn't even plan for that to happen. We were doing all kinds of worst case scenarios. These guys jet on us or whatever. And it was still a good deal. It was a good deal. It turned into an unbelievable deal.
Yep.
But didn't start out that way.
Yep. And I think there's a couple lessons. One is you were trying to hit a base hit, right? 2, you got creative with it. 3, you found a way to create additional value. And hey, there's opportunity here, there. Let's have a conversation with them. Let's see how it goes. You could have said no and just had them keep on making payments to you,
and it would have been unbelievable.
Right.
I mean,
and so and then the other thing is, what were we talking about offline? Staying in the game, right?
Yeah.
And then the other thing is, what we were talking about offline is like those in the park home runs don't just fall in your lap, right? Like you are in the game, you're looking at deals, you're making offers consistently. Somebody might see that deal and be like, oh, Ron's lucky, and if I got one of those a year, I'd be in good shape. The reality is...
So would I.
Yeah, right. But the reality is, the reason that comes across your desk and the reason it turns into that is because you're consistently in the game, looking at bad deals. And killing bad deals,
Let's not forget, though, too, that, somebody starting out in the business thinks that... It's like... I used to hear my dad, he used to say, man, the kids today want everything their parents have, and they want it now, Mm-hmm. And, well, there's nothing wrong with that if you can actually make that happen, right? But a lot of times, it's, people discount the fact, I've been doing this for over 2 decades. It's not like, when I first started this, like all these deals just came across my desk. I didn't even have a desk. I was broke. But now they actually do come across my desk. I see tons of deals that I actually don't shop for because people know that I'm buying. And 98% of them are crap.
Yep.
I mean, crap.
You're going to waste your time. This is probably one of those
money.
Things. Yeah. You're going to waste time. You're going to waste money. You're going to do due diligence and spend money on all these different kinds of things and walk away from deals. But it's part of the business. It's part of the part of the plan. It's part of the just being in business. And so, and so that's part of it. But then the other thing is like the compound effect of over time, right? Like we all want to make a ton of money sooner than later, but there's these growing learning lessons and growing pains that we all have to go through, and reputation builders, right? Like you built your reputation over 20 years to be known as somebody who transacts and closes and does what they say that they're going to do. And those deals didn't come to you initially, right? Like they weren't brought to you 20 years ago. It's taken 20 years of reputation building in order to then have those start getting brought to you.
And it's how you handle the ones that don't turn out very well, especially when you have investors' money in them. You know, not every deal I've done has been a base hit.
Yep.
You know, I did a deal. Gosh, I think it's 7 years ago now. We were talking about before. I did this deal, and on paper it was great, and for 3 or 4 years it worked great until it didn't, and then it was one of my first syndications. Mm-hmm. So I had really high pref, I had a really high split. Mm-hmm. And when the cash flow started to not work because my loan reset, we should talk about that.
Yeah, let's talk about it.
When my loan reset, I was trying to, it was these townhomes, right? And I was trying to sell these townhomes off one at a time because the financials wouldn't work for me to sell them off as a package. I had bought it from a bank. They gave me an unbelievable loan. It was like 2% loan, which made the numbers work, so I got great terms. Well, I couldn't sell them for enough money because the market hadn't rebounded yet to the retail world, and I couldn't sell them because I couldn't get the rents high enough to sell them.
So investor didn't want them.
So I was stuck with these
didn't
things.
Want them.
And they cash flowed just great for a while. And then when my loan reset, I had to walk back into the bank with money, with cash, and I got reset at a higher interest rate. Mm-hmm. Now I'm trying to make pref, so little Ron is not getting jack squat, and I'm barely making pref, and I'm putting personal funds in to try to make sure that I don't have to do a capital call or something crazy. And as I walk through this deal, this is like 7 years of mostly just slogging on this deal, which sucks because I knew at the end I had a 90-10 split, 10 me. Okay, so I know I'm going to make no money.
Yeah.
And I just had to keep how you handle your investors in that world. So what I ended up doing, I had to create an HOA. I had to do all of this work, legal work that I paid for. All of that stuff I did so that I could sell these things individually on the open market retail. It took me 18 months to sell them all because I had to wait for tenants to move out and then clean the units up, sell them so I could get all of my investors' money back and all of their pref and a little. And I didn't make anything. Yep. So all of those investors, though, will invest with me again.
It's a testament to your character.
They know that worst comes to worst, I'm gonna make sure they get their money back, even if I don't make any money. Yep. And so that kind of reputation capital launches you into, okay, my money's safe with this guy, so I can do a deal even if the deal doesn't work the way that he thought it was. One of my worst deals ever that I've ever done. It just happened to have investors' money, which is a weight that unless you understand, you don't understand.
Dude, yeah. I mean, it's when you have deals like that aren't going very well, and you have the responsibility, like, because you actually care, right? Like, I actually care.
I care more about their money than my money.
100%. There's firms out there that don't care, and they sleep just fine at night. But like, for guys like us that actually care and they understand that this is somebody's, investment, their family money, their wealth that they're building for their family and their kids, and they want to pass it along. It's like there's sleepless nights, and there's a lot of responsibility that comes with that, and you got to be prepared for that responsibility if you want to take on other people's money.
And the whole reset thing. So there's a ton of people who jumped into the commercial real estate world, and the only experience they had was residential experience, and they're going to get they're currently getting wake-up call, and they're going to continue to get them over the next, call it 24 months as their loans reset. the people who have bridge debt out there.
Yep.
Because they're going to reset into expanded cap rates, which means the value of their property is going to go down.
I just got bit by or stung by a bee. That fucking thing just stung me.
Through your shirt.
Yeah,
That's
I leaned on
legit.
it.
Keep that in. That's really good.
You guys didn't tell me it was behind me?
Yeah, I said B.
Holy shit, it hurts. That's fine. All right, let's keep going.
Where's the EpiPen?
Oh. I'm still getting.
So this is how everybody's going to feel when their loans reset.
Yeah.
Right here, just so you guys know. And they're currently feeling it right now. It doesn't go away. It's just sitting there.
And then it just pulsates. It just pulsates. You're
Yeah.
going to feel it for a long time.
Yeah.
You're not allergic, are you?
No, I don't think so. Why, am I turning red?
Your ear is really big, though.
Yeah.
Pitch.
You're in a hunchback now?
Dude, it's a real problem that's getting ready to happen. It's going to affect the banks. And
Well, it's happening right now with new construction, right?
Yep.
So like that's all these new construction loans that have typically the shortest bridge terms. Everybody who bought and built, and now their loans are coming due, they can't refinance out of those loans.
Nope.
And so because one, they put these huge valuations, expected cap rates to stay low, interest rates to stay low, and now they either need to come to the deal with a bunch of money, or they just can't refinance. So the lenders now have a decision to make. They're going to either decide to take these properties back, or they have to do loan modifications with these borrowers. And now I heard that a third of all bridge loans are coming due this year.
that's correct, within the next 18 months. And that there is just shy of $90 billion of commercial loans, not bridge debt, commercial loans, that are currently either not paying or can't pay. Wow. And they're going to reset. So think about this just for a second. This is the thing that people don't understand.
Does that include like bridge loans, like a value add? Because I have value add deals that I buy, and I know that they're not going to cash flow until it's stabilized.
Nope. These are deals that are resetting. So, you're typically getting 5-year money on apartments. You can get up to 10-year money.
Yep.
But on most commercial deals, like our commercial deal, when we bought that thing, we have 5-year money.
Well, if you have a bank loan, that's the case. If you go through an agency lender, then you can get longer terms, right?
So, a lot of these people are on 5-year money.
Yeah.
Some of them are even on 3-year money. Rates were so good back in the day, people would get the lowest rate they could, and that was usually 3-year money, 3-year, 5-year money. And these guys are, they're in trouble because as the cap rates expand, your property's worth less money. Mm-hmm. When you have to refinance,
whether it is or not, and you think it is, on paper, it's worth less money.
Yeah, it doesn't make any difference what you think.
Right, the bank doesn't care.
Nope. And so when the bank, because the banks have regulations too, right? So if they made this loan on their books at 75% LTV, and now the LTV ain't 75 anymore because of the valuation came down,
Yep.
you have to come to the table with money.
Yep.
And that's what happened to me. Well, now that's going to happen on steroids because mine was just a little bit of money, not a big deal. This is millions and millions of dollars. And in addition to that, they're resetting into interest rates that are probably somewhere around double.
Double.
That hurts. That hurts really bad, especially a lot of the offering memorandums that I saw were super skinny margins on really big deals.
They're trying to make deals happen. Hey, I think rents are going to grow by 5 to 7% every year for the next 5 years. I think interest rates are going to stay flat. I think
after I raise the rents,
right.
$250, and I don't do any work. Right? I'm just going to raise the rates.
And then I think I'm going to buy this, and I'm going to assume taxes stay steady, and they're not going to increase to get reassessed.
Of course.
Dude.
Yeah, the last guy bought
insurance.
it for $1 million, sold it to me for $5 million, but the taxes aren't going to go up.
Dude, or insurance. Like, insurance is one of these things. Like, why aren't more people? Insurance rates have doubled in almost every market, and in the
crazy.
coastal markets, it's 3 to 5x, man.
Yep.
These insurance rates are just bananas. So you're looking at all the different variables, and it's even if you do operate the property decently well, but your insurance rates increase by that much, that's going to affect the net operating income, which is going to affect the valuation and the cap rate.
If the cap rate moves, I mean, If the cap rate moves 0.5% or 1%, for most of these people, they're done. Doesn't
They're
make
done.
if everything stayed the same on their financials. Net operating income is exactly the same as it was last year. Their property's worth substantially less.
Do you think
1%?
Do you think the banks are, like, if they're paying their mortgage and the property's stabilized and they say, hey, interest rates went up, what does that look like? What is the bank's perspective on something like that? Do you think they're dumb enough to say, hey, I need to take the property back?
So in 2008, what happened with all of these properties? They were forced to dump properties because when the regulators come in,
Because they have to answer to somebody.
yeah,
Yeah.
yeah. So most of these loans are held by regional and local banks. They're not. So this is the other thing that they're reporting in the financial news, that Chase and all these big three, they're fine because their portfolio of commercial paper is like 5% of their. Well, so that's no big deal. That's not going to make any regulator go crazy. Go to your regional bank. Go to your local bank. They're writing a ton of commercial paper. They're the people who do most of the commercial lending for guys like us in local markets.
Yep.
Especially paper that can't get done agency. So those guys have a considerable amount more.
Yep.
So take the, what was the name of the bank that just that started all this?
Oh, you're talking SVB?
Yeah. So
SVB,
those guys,
Signature, and First Citizens.
so those three banks, they had a problem with liquidity, and they had unrealized losses, uncapitalized losses on their books. Well, that's literally what's happening right now. Because if you look at the books, and if the cap rate says it's a point higher now than it was last year, there's an unrealized loss. That's a loss on paper to the bank, right? So on their books, if they're forced to market that loss, they're in trouble because they've now lost all of that money.
So what happens? Right. So then they come back to the operator, whether they're a good operator or a bad operator. The property could be totally stabilized, but then they come back to the operator, and what does the operator have to do?
This all depends on what the regulators decide they're going to do, right? So if the regulators come in and say, we'll let you loan mod all of these crappy loans now, okay, fine. But we don't know what's going to happen. In 2008, they didn't do that. 2008, they came in and said,
they just took everything.
You're done. You sell everything, and then they bailed them out. But they had to sell everything. That's what tanked the market in areas that the market shouldn't have tanked, because these banks were dumping all of their assets, no matter whether it was in California or Florida or the Midwest, which didn't really have a problem.
Right.
And then, because the regulators made them do that, think through the long-term effects of this, right? We didn't even see the bottom of the market until 2012 in Kansas City, right? So I'm taking Kansas City for instance. Kansas City didn't have a problem, really. Shouldn't have got cut in half. But a property that sold for $150, the bank is now selling those properties at $85,000, almost half price.
Yep.
Now they've set the comp. And at the same time, the regulators came in and they said,
Now,
hey,
nobody else can sell their property
you guys can't use anything else other than a comparable. So the other two means of appraising a property you can't do anymore.
So based on cash flow or building cost.
Can't do it. So now your only method is a comp. Well, now my comp is $85,000.
Yeah.
So now when the bank has to dump some more, guess what the bank did to themselves? So the regulators forced them to do that.
And
the regulators forced the appraisers to do what they did, and it smashed the market for years and years and years following. I mean, that was longer than it needed to be, because in a lot of these markets it wasn't overbuilt.
Yep. No, I agree, and it was unbelievable. Like, my first apartment building I bought was in 2012. At the end of 2012, 8 units for $30,000. An 8-unit building, and 3 of them were occupied.
You want to hear the worst deals I ever did? I bought in 2009, 10, 11. 9 and 10, I think. We were in Florida buying brand new properties that had never been lived in for $35,000 to $40,000. They all sold for $350,000, somewhere around there, $350,000. And we sold them all for $75,000 a piece, and we thought we roped it. We thought we roped it. I should have kept every one of those.
Man.
That was the worst
Yeah.
real estate deals I've ever done.
Dude, you don't,
And at the time, I thought they were the best. But looking back, and that's part of the reason why I've sold what I'm going to sell,
yeah.
and I'm keeping the rest of the stuff.
We're on such the right wavelength because I was just going to say, like, you have a business that transacts 500 houses a year, right? But you operate it as a business. That's not your own personal investments. It's meant to be a business that generates cash flow, that then you take that cash flow from, and then you go and buy great assets.
Yep.
But the wealth isn't built like it's. You need the quick money, like we were talking about, and then you want the long-term wealth, and but the real wealth, like the wealthiest people I know, they don't sell great properties. They buy great properties
And if they do,
in great areas.
they sell it and move the money into another great property.
Yeah.
Or
they
two or
get
three.
a bigger great property or even better property, and we just keep doing that. So let's go back for a second over to what can an operator do? What are the best action steps that they can take in order to make sure that they don't fall into a situation where the bank's calling their loan due? Can they do anything? Is it totally out of their control? Is there?
Well, a couple things that come to mind immediately. The first one is get ahead of it. If you know your loan is going to reset in the next 6 months, call the bank and find out what's coming so that you can prepare for it. The second thing is the money that you're refinancing into may be about the same as you can get private capital.
Yep.
And private capital is a hell of a lot easier than the banks.
Not
Right,
subject
so-
to bank regulations.
Nope. And if you pay them, they're whatever 6.5, 8, whatever the number is. If you pay them their money, they're not going to do anything. That's what they're investing for. They want that money. So if you have the ability to reset into private money, that's an avenue that you should definitely look at.
Smart.
But first, go talk to the bank, because the bank may not be over leveraged into commercial, and they may work with you. Who knows?
Yeah, I think so too. I think getting ahead of it is a big deal. I love what you just said about just go out and raise the money. Depending on the size of the deal, I was talking to a couple of my buddies who have a mobile home park, and they're trying to get a $3 million loan on this mobile home park. They have access to a lot of private money. And I was like, why don't you guys just create a fund? I mean, you're trying to get an 8% loan from a bank. Why don't you just go create a fund that's a debt fund, right? Raise $3 million in it, pay an 8% preferred return, and then the only asset that it lends against is that, and you can give that fund a mortgage on the deal, so it's like secured. It's 8%, and now you're controlling the market. You're controlling and creating your situation as opposed to being subject.
And you create the
to
terms.
Right.
You can create your amortization schedule, or you can do interest only.
No
you can do
points,
whatever you
interest
want.
only. Yeah, like no.
So long as you can sell it, and it's good for your investors.
Exactly.
What difference does it make?
The third thing that I would say is, it's been easy to access capital. It's been easy to find deals for the most part over the past few years. So many people have neglected the operations, right? And so you got to get good at operations. You need stabilized properties. If the property's not stabilized, no bank is going to give you a loan or do a loan modification or give you a new terms if you're
and
not
investors aren't going to
operating
be super
well.
happy about it either.
No.
So
you got to focus on operations to get serious about that, on stabilizing the properties.
Yeah, and if you've been loose on that, there may be a way for you to get your NOI back in line so that you don't have the problems that we're talking about. Hopefully, right?
But that's a controllable, right? Like,
but man,
control the things that you can control.
Here's the thing: I tell all my coaching students and anybody else who will listen, know your numbers, and then do something about them. So many positive thinking people, which happen to be entrepreneurs, like we're super positive,
right.
optimistic. But if you're so optimistic that you can't look at something that's bad news and go, okay, I need to do something about this now, instead of punting way down the road, you're going to get over there. You're going to get smashed. Where here it's going to hurt, but it's not going to hurt like it's going to hurt over there.
Yep.
And if you can't figure that out, you shouldn't be in business. You just shouldn't be in business. And I watched people last year, was a shot over the bow. Last year was not a meltdown. The market stopped transactioning for a few months and reset a little bit, but it didn't go down. It didn't go down.
Right.
So most of these guys that got in trouble last year, it was all because when you asked them what they were making like on a flip, what'd you net on a flip? 40,000. So then you dig in a little bit on the 40,000. They didn't net $40,000. They grossed $40,000. Right?
Yeah.
That's a fundamental misunderstanding of how financials work.
Faking yourself out, man.
And it's all ego.
Yeah.
Like what's in your bank account? If you actually ask the guy who's doing, 100 deals at $40,000 a pop, what's in his bank account? It's not 4 million.
250,000.
Yeah, it's not 4 million. So you didn't net 40 on each of those deals, and the fact that you don't know what you netted on those 40 deals is a problem. That's a problem.
Yeah.
It's a solvable one that you have to stare in the mirror and go, okay, this isn't as good. And if you'll open up to somebody who actually could help you and say, I've been telling everybody this is good, it's not good. I know it's not good, but I don't understand how to fix it. Somebody can help you fix it.
Yeah.
That's what I'm trying to say about the banks. Go to the banks, figure out what your real problem is, what your real exposure is, so that you've got now 6 months or a year, you can fix part of those problems and your exposure shrinks.
Yep.
But if you wait to the year mark and then get pissed off at the bank, well, whose fault's that?
That's right, man. No, I agree 100%. I think either you're going to be very honest with yourself right now, or the market's going to be very honest with you 12, 24 months down the road.
That is 100%.
And they're going to show you what that looks like. So,
quote Tim Bratz.
well, dude, I appreciate you, man.
Thank you, bro.
Always have such good conversations with you. I have a ton of respect for what you got going on, and just
likewise
excited to see where the next 24 months leads for you.
Awesome. This was fun.
All right. Hey, so many nuggets with that sit down with Ron. Big takeaways, big things that you can take action on, things to bulletproof your business and make sure that you don't wind up handing properties back to the bank. So do things the right way, do things by what the right thing is to do by your investors, and make sure that you're controlling the controllables. Make sure that you are handling operations. Make sure that you are doing all those things that Ron and I talked about to put yourself in the best position to capitalize on new deals, better deals, big deals that pop up, big opportunities that pop up over the next couple of years. So make sure you connect with Ron. He's always putting out great value, just a great person to have in your network. Would love to hear your biggest takeaways from today's episode in the comments section below. And please share this with somebody else who you think might get some good value out of it. Like the episode and make sure you're subscribed to Legacy Wealth. We do this to try to bring as much value to you as humanly possible. And all I ask is subscribe to the channel, share it, so that way other people can get the same value that you have. So appreciate you being here. See you next week on Spilling the Beans.